This is what Tom Lee just said about CPI tomorrow and what could happen to markets. Tom Lee in Fundstrat says if June core CPI coming out tomorrow is below 0.25%, that likely triggers rotations in small caps, industrials, financials, and laggard fangs. Our base case remains that July is a positive month for stocks, supported by softening inflation picture and by the still lingering skepticism towards stocks. And here you can see this chart or image from Fundstrat that has Wall Street's current estimates at positive 0.21% for CPI month over month on your core. So Fundstrat actually believes we could come in a little bit higher than Wall Street's consensus estimates, and that would still be seen as positive for stocks. Over the last two CPI reports, the one-day return following a better than expected CPI in April and in May was positive 1.2% and positive 0.9%. The 5 days later, following April and May, you both had a 1.1 and then a 1.8% positive return. And the last CPI report we had that came in worse than expected, you were actually down almost 1% that same day. You were down about 0.9%. And 5 days later, the S&P 500 was down about 3.6%. So recent history would suggest if inflation comes in hotter than expected, you can be in for a downward price action trajectory for the S&P 500. Vice versa, if it comes in better than expected, you tend to see a larger follow-through rally. Now, I would say, judging off of the last few days, you can kind of tell the markets are expecting a good inflation report. I think the thing that makes tomorrow's CPI report a little bit more difficult is because we do have these low expectations, and oil actually climbed about 17+% in the month of June. Now, of course, core CPI likes to strip out oil, but that is an inflationary pressure on every business in the world, regardless of whether you tried not to calculate it or you do, whether you're looking at headline CPI or core CPI, it still typically has an impact on core CPI. And we're not expecting, much of an impact at all from oil, which personally, I can't recall another period in time where you had really low inflation expectations and oil went up 17% in a month or anything close to that. That's a huge 1 month rally. Not saying inflation, especially core, is going to come in hot, but just something to consider. Now, Tom Lee and Fundstrat also posted this. It says, of the 19 companies that have reported so far, 4% of the S&P 500. Overall, 84% are beating estimates, and those that beat are beating by a median of 2%. Of the 16% missing, those are missing by a median of 1%. On the top line, overall results are beating estimates by a median of 1% and missing by a median of 1%. And 53% of those reporting are beating estimates. And you can see, I think this is pretty interesting. You have Q2 2024 Street Consensus EPS as of June 30th that is supposed to come in around $58.64. Currently, if we aggregate some of the earnings that we have gotten so far, that would be EPS of $58.53 per share, so missing estimates overall in the S&P by about 11 cents. That would be a negative 0.2% change versus the actual expected results and the estimates that we had, which does suggest from this data, and again, only 4% of the S&P 500 has reported, that you may actually miss Wall Street's current estimates by a slight margin. And I think in this market environment with stocks just soaring to new highs, you need to beat by a pretty impressive margin. Coming in line with estimates is just not going to be good enough. And I do think earnings, this earnings season specifically, poses a big risk because of the rally that we have seen. But again, it's important to remember that corrections, especially if we do get one, they are normal, they are healthy in bull markets. And I think this is likely going to be a bull market until the economy worsens or until the Fed cuts rates for the first time. That typically leads to a sell-off of over 20%. But it does appear as if Tom Lee and Fundstrat are still bullish on stocks throughout the rest of this week, when seasonals are the strongest throughout any year. Yes, the first 2 weeks in July are stronger than the Santa Claus rally. They're stronger than the start of the year. They're just the strongest 2 weeks of any year. The second half of July tends to be one of the weaker periods of the year, and I'm sure that's a potential risk that Fundstrat and Tom Lee are also considering. That does also align with when your big tech names will be reporting earnings, as well as in early August, and that's something to consider as well. Now, we do have some estimates from JP Morgan. Long story short, JP Morgan says on a potential market reaction to CPI tomorrow, there's basically an 82.5% chance the market will rip higher. Now, here are the actual expectations. If we're below 0.1%, the probability of that is 2.5% according to JP Morgan. That is an S&P 500 reaction of 1 to 1.75% positive. Between 0.1 and 0.15%, there's a 15% probability of that. You're positive between 1 and 1.5% tomorrow. Between 0.15 and 0.2, there's a 35% chance of that. You likely get gains of a half of 1% to 1%, and between 0.2% to 0.25%, which is a 30% chance, you have gains of 0.25 to 0.75. Between 0.25 and 0.30, which is a 15% chance according to JP Morgan, you're down 0.75 to 1.25%, and above 0.3%, which is a 2.5% probability, you would likely be down 1.25 to 2.5% for the S&P 500. So basically, in the best case scenario, you can expect gains of 1 to 1.75%. In the worst case scenario, you can expect losses of 1.25 to 2.5%. So call it 1% up or down is probably what we should expect tomorrow. Although it's been a long time since we have gotten a 1% decline in the S&P 500, it definitely feels like the path of least resistance for markets is higher. And again, I think it will be that way until we get earnings. And I do think CPI is probably going to be seen as a positive for markets, even if it does come in slightly hotter than what Wall Street is currently expecting. People just don't want to change their opinions, their consensus right now. Volume's low, it's summertime, people are away from the office. And that's why stocks continue to go higher, really for no rhyme or reason. I should mention, this is what? 1, 2, 3, 4, 5, 6, 7 days in a row the S&P 500 has been green. I think you could be vulnerable for maybe a sell-off on CPI, but again, that looks unlikely. But if we're green tomorrow, that's going to be 8 straight days in the green. And this is a post from Heisenberg. This says the last 8 CPI reports and how the S&P 500 did the next day. June, up 0.86%. May 15th, up 1.18%. April 10th, down almost 1%. Recovered it all the next day. March 12th, you were up 1.13%. February 13th, you were down 1.3%. Recovered it all over the next 2 days. January 11th, you were flat. December 12th, you were up 0.5%. And November 14th, you were up 1.9%. He says, notice a trend here. Buy, and or all dips got bought. Next CPI data drop is Thursday pre-market. Good luck. So it definitely seems like even if CPI comes in a little bit on the hotter side, you still get markets that tend to buy it up over the coming couple of days afterwards. Isabel Net on X shares this that says the percentage of S&P 500 stocks above their 20-day moving average is showing signs of a bearish divergence, which can be an early warning signal of a potential market correction. And you can see the percent of stocks trading above their 20-day moving average declining. At the same time, markets are going higher. This does historically tend to lead to a downside price action in markets. You can also see the S&P 500 has now reached the 78.6% extension off the March 2020 low, which is a pretty important Fibonacci retracement level. Equity put to call ratio drops to the lowest level in 12 months. That just means there's not a lot of people buying puts out there today. And normally when consensus is shifted so far in one direction, you do get a reversal because after all, you can't have the consensus be right? And why can't you have the consensus be right for an extended period of time? Well, if consensus is markets are going higher, then that's the bulk of investors that believe markets are going higher. So people that are short, the smaller minority crowd, they're the ones that are paying out for that upside, right? They're the ones that are losing out. You can't have that happen for an extended period of time, because then you run dry all of the bears, and then that just doesn't happen, right? Usually the people that are the contrarians, the smaller group, is inevitably correct and paid out handsomely. Kind of like the Great Financial Crisis. If you guys have ever watched the movie The Big Short, those few individuals that were first that got it correct, that the housing market was collapsing, were paid out a lot, right? And that was because there was only a few of them. If everyone had the consensus view that the housing market was going to collapse, the payout wouldn't have been nearly as good. But if you were curious just how stretchy S&P 500 long-term PE multiples can get, you're not even really close to how high they could get. I guess you're close. You're sitting at about 34 times, whereas even back in 2021, you got up to 38 or so. And during the dot-com bubble, you were roughly about the same at about 38.5 times. So there still is a considerable amount of room left that we could run with valuations, but then again, that sets you up for another 2022 or dot-com like scenario that's not exactly good for markets either. Small cap stocks are down 2% on the year, while large caps are up 17%. This is the biggest outperformance of large over small since 1998. Bank of America says this about Q2 earnings. Other 493 back in the black. We expect a 2% beat, up 11% year over year, in line with the historical average, and the smallest since Q4 of 2022. So they do seem positive on this earnings season, but expect it's going to be the smallest beat that we have seen in about almost 2 years now. Which again, I don't think markets are priced for a small beat with earnings. I think markets are priced for a huge beat on earnings, just judging off of the S&P and the NASDAQ. Ryan Dietrich reposted this chart from Scott Brown that says semiconductors with a monster bearish momentum divergence as they retest the June highs, and that is when the RSI is lagging behind where it previously was, as you were at a previous all-time high. So the RSI at 66 on the SMH, and you're approaching a new all-time high. The relative strength is not nearly as good as it was back in June. In fact, there's actually a bunch of bearish divergences out there. Even if you look at the RSI on the S&P 500, there is a pretty clear bearish divergence between just the monthly candlestick chart, right? When you had the RSI at 89 back here in 2017, and then back in 2021, the RSI on the monthly candlestick chart hit 79, and now the RSI is at 71. Yes, you're overbought in the monthly candlestick chart, but as you are hitting new all-time highs, the RSI is not playing along, and I think that mainly has to do with market breadth at this point. The fact that it's so bad, it's just not allowing that relative strength to go up in par or tandem with what the markets broadly are doing. And that's just two of many different momentum divergences that are happening out there today. Seth Golden says, something tells me they're going to burn upcoming CPI report to the ground. Put to call ratio has only been this low 4 times in 2024, but hasn't held this level for more than a day until now. Outside reversal on watch for indexes post CPI release. So he's actually saying markets could fall on the CPI report, and he's very bullish on markets. And I think another troubling sign, if you will, for markets is the fact that McDonald's has now closed at the lowest price since October of 2022. If stocks like McDonald's, blue chip names, continue to get beaten down as the markets continue higher, I don't think that's a good sign for broader equities. Seth Golden also says on X, growth dominates value. In the last month, daily correlation went deeply negative. That suggests that lagging large cap managers have panicked with rotation out of value into growth, regardless of price. This capitulation marks the end of regimes like 2000. And this is from the Leithole group. You can see the chart that Seth Golden is referencing. When you get this line downwards, right here where my cursors are, that tends to mark some pretty important tops and subsequently large downward price action. Liz Ann Saunders, she is the chief investment strategist at Charles Schwab, writes on X, the 10 largest names in the S&P 500 now account for nearly 37% of the index in terms of market cap, highest concentration since 1972 per NDR research. Ryan Dietrich writes on X, S&P 500 up 6 days in a row, but only up 2.13% during the win streak. That is one of the weakest 6-day win streaks ever. Incredibly, October of 2017 saw a 6-day win streak with the S&P 500 up only 0.95% those 6 days. Goldman Sachs just said this on X, quote, since 1928, July 17th has marked the local top for the month heading into materially lower August. We are modeling a late summer equity market correction. August is the worst month of the year for equity flows as capital has already been deployed. They specifically write with this chart here, August is the worst month of the year for equity flows. There are no predicted inflows in August as the capital has already been deployed for Q3. Buyers are out of ammo and I am on the lookout for outflows. And let me know what you think about this down below in the comment section. It comes to us from the great Martis on X. It says crash alert 1929 versus 2024, a perfect 465% rise depicted on both charts from the lowest point of the broadening bottom formation depicted to the top. And this is basically looking at, from 1915 through 1929, which again, there's been a lot of differences in how markets operate and changes, during that period of time to now. So there is huge differences here, but the charts do look pretty similar if you were actually looking at them arbitrarily. And this goes from the .com bubble until today. So let me know what you think about that down below in the comment section. And as Nick Timmerhouse pointed out on X, these are the estimates for June CPI from your major banks. As Tom Lee said, anything lower than 0.25% would be positive for stocks. Now, in fact, of your major Wall Street banks, only 2 of them are expecting a number of 0.25% or higher, one of which is Deutsche Bank, and the other one is Morgan Stanley. Deutsche Bank is expecting 0.25%, and Morgan Stanley is expecting 0.27%, again with the consensus view on Wall Street being 0.21%, which, believe it or not, this would actually be a rise from last month's CPI number of 0.16. So preferably if we did come in with a number like Nemera Bank is estimating of 0.14, it would be a very bullish day for markets. And I would expect small cap stocks would massively outperform. What's actually interesting about today is you do have the indexes overall doing pretty well. The Dow is up 0.5%, S&P up 0.7%, NASDAQ up 1%. Even the Russell 2000 is up 0.62%. But take a look at the VIX. That's up about 0.5% as well. There are some firms that are going out and buying some put protection heading into the CPI report tomorrow. And although the CPI report is the biggest set of data we get tomorrow, we do have other data as well that will be coming out, including initial jobless claims that comes out at the same time as CPI at 8:30 in the morning tomorrow. We are expecting a little bit of an uptick from last week's 238,000 initial jobless claims up to 240,000. I think what's very important to watch for as well is continuing jobless claims that have been going higher in recent weeks. You can see from this chart, it's been a steady stair step higher. If you do see this go higher again, well, that's going to be, something the markets look at and say, maybe the maybe the labor market is weakening more than we think. You will also get a speech from Fed Bostic at 11:30 in the morning tomorrow. You will get a 30-year bond auction at 1 p.m. And coming out later in the day tomorrow night, actually, at about 11 o'clock at night, Eastern Standard Time, you will get the balance of trade coming out for China, exports and imports. Jerome Powell did make some statements that sounded a little bit more dovish today, and that is certainly helping out the markets, one of which is this. Well, this one's a little bit more hawkish, but he did make some very dovish statements as well. He says it feels like policy is restrictive, but not intensively restrictive. That suggests the neutral rate is a little higher than before. He says we need to be mindful of the labor market. I have seen considerable softening there. Powell said, I do have some confidence inflation is coming down, but I am not prepared to say I am sufficiently confident in it coming sustainably down to 2% yet. He also said, I don't have a particular inflation number in mind for cuts. Interesting, Jerome Powell is sometimes asked, in which he was today, what keeps him up at night. And normally he answers that with cybersecurity, right? We've had financial crises, we've had banks go under, we've had pandemics, we've had all of this, and we know how to manage that. But it's cyber attacks that we don't know how to manage, that we wouldn't exactly know how to manage. But he added something else today. He actually said today that it keeps him up in the wee hours of the night thinking about the dual mandate and now the risks to the labor market and getting that right, which is a different answer that we have gotten from Powell. He definitely seems a lot more concerned about the labor market than he previously was. Andy Constein on X says, I was running a huge equity derivative business during the internet bubble. This is not like the tech bubble. Biggest drawdown from peak since Microsoft invested in OpenAI has been 10%. No meaningful drawdown along since October. The tech bubble was much less complacent. Many meaningful drawdowns, and you can see this was the tech bubble. There was a bunch of drawdowns of 10%. 1, 2, 3, 4, 5, 6, 7, 8, right? And now, yeah, you haven't really seen any. You've seen one. And that's it. And this is a pretty interesting chart from Seth Golden, yet again on X. You can see dating back in the S&P 500 history, anytime that you are positive by 15% or more through the first 130 days of the year, you tend to see the rest of the year be positive as well. Not as strong as the first half of the year normally, but very strong. In fact, only in 1983 were you actually negative in the last half of the year. And as Michael J. Kramer on X points out, the S&P 500's RSI is above 80 and above the upper Bollinger Band. That means markets are 2 standard deviations higher than the 20-day moving average, which is normally when you see things tend to correct back to that 20-day moving average. Over time, you do tend to see the markets revert back to that 20-day moving average, which could be a fall back to about 546 on the SPY. If you track the S&P 500 using the SPY, which I think most of us do, that would be a drawdown of about 2.3%. So nothing large. Charlie on X shares a chart of the top 50 largest stocks in the S&P 500 that have a median return of 13% this year, while the 50 smallest stocks in the index are down 12%. So the bifurcation does continue with, you know, the largest stocks continuing to outpace the smaller ones, which I do find very interesting. If Wall Street's current narrative is still, we're going to have a soft landing, and we're expecting the first Fed rate cut in about 2 months, shouldn't we start seeing the broadening out pretty soon? Let me know what you think down below in the comments section. The percent of stocks trading above their 50-day moving average is pretty good today, actually. You do have about 2.49% of all stocks trading above their 50-day moving average. I think relative to the S&P's almost 1%, NASDAQ's over 1% return today, this is not as impressive, but you are seeing more stocks going up than more stocks going down. And it seems like retail investors are not that confident in the S&P 500, with sentiment today that is bearish at 38. And yesterday's sentiment was bearish at 26. So this is actually an improvement from yesterday's sentiment, but still doesn't look that great. Message volume is still at 61, which is high just like it was yesterday, and participation today is normal at 53. We did get a new Atlanta Fed GDP Now tracker update that is estimating GDP is now at 2%. Yesterday it was at 1.5%. Markets are currently assigning a 4.1% chance of a July 31st rate cut, but they are assigning a 72% chance of a September 18th rate cut, which again would make you think maybe you should start seeing a broadening out, or probably we should have already seen the market start to broaden out if we are less, or not less, but about 2 months away, 8 weeks away from the first Fed rate cut. We are also pricing in about a 34.6% chance of a cut November 7th and 46.6% chance of a cut coming December 18th. There is a 26.6% chance that we see a cut September, November, and December. So 3 cuts this year is priced at 26.6%. 2 cuts is priced at 46.6%, and only 1 cut is priced at 22.5%, and 0 cuts by December is priced at 3.3%. So let me know what you think about all of this information down below in the comments section. The like button and subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.